Emerging markets have long followed a predictable cycle. When global capital pulls back, the local economy immediately begins to contract. By early 2026, India appeared to be entering the most severe phase of that cycle. Foreign investors pulled $20.2 billion out in 4 months, marking 11 straight months of net selling. Comparing this to the previous year reveals the true scale. This flight is nearly 9 times larger than the outflow of 2025. Historically, a drain of this magnitude would force a sharp devaluation and a recession. Instead, the Indian economy is picking up speed. The correlation between foreign investment and domestic growth is under pressure, creating a real-time stress test for the nation's financial stability. The primary evidence of this acceleration is found in the banking sector, where credit growth recently hit 17.7%. Examining the 2-year trend confirms this is the strongest expansion of credit since mid-2024, a peak few analysts expected during global tightening. An expansion this rapid creates its own set of questions. Is this a surge driven by productive investment or a signal of a building credit bubble? To find the answer, we have to look past the foreign sell-off and identify the specific forces now providing liquidity to Wall Street. Domestic institutional investors have emerged as the primary shock absorbers for the Indian market. These domestic funds are fueled by a consistent stream of capital from everyday Indian households, which are contributing record amounts through monthly systematic investment plans. This massive domestic liquidity effectively absorbed the foreign sell-off throughout early 2026, purchasing the assets that international funds were exiting. Market momentum currently relies on this local confidence, which has remained resilient despite the volatility of global investor sentiment. Determining if this credit growth is sustainable requires a breakdown of exactly where that 17.7% is being deployed. Industrial lending rose by 17.5%, with much of that capital allocated to engineering and physical infrastructure projects. Small and micro enterprises also saw a massive influx of capital, with their borrowing growing more than 3 times faster than in previous years. Agricultural credit grew by nearly 15%, supported by the ongoing formalization of rural financial networks. Personal loans grew by over 15%, a segment dominated by stable housing and vehicle financing, rather than high-interest unsecured debt. Factories are upgrading and infrastructure projects are moving forward, suggesting that the current growth cycle is increasingly powered by domestic borrowing. However, while the system weathered the external flight of capital, an internal pressure point is beginning to show in the banking ledger. In 2 months, bank credit expanded by 1.5 lakh crore rupees, while deposits contracted by 2.3 lakh crore. This created a 3.8 lakh crore funding gap. The credit-deposit ratio hit 82.8%, signaling tight liquidity. Banks have responded by reducing their investments in government securities, effectively freeing up cash to meet the high demand for private loans. The financial system is currently tapping into its own internal reserves to sustain the credit needs of the broader economy. India's economy is currently testing a new model of growth, attempting to maintain its pace while foreign participation hits a decade-long low. Economic demand is present across nearly every sector, but the constraint has shifted from a lack of projects to a lack of available liquidity. Long-term resilience now rests on the banking system's ability to mobilize enough domestic savings to keep this growth engine funded.